If you're running a business in Canada or thinking about starting one, there's a fundamental question you absolutely have to ask. Is my company structured correctly for tax purposes? The answer to that question isn't just paperwork. It has massive financial implications. Today, we're going to break down the core principles of Canadian corporate tax, really demystify them, so you can see how to unlock some very powerful built-in advantages.
Just for your reference, this detailed overview was prepared by Samir Al-Rashani, with some assistance from AI, all to provide you with a clear, structured guide to what can be a very complex subject. All right, so here's our game plan. We're going to build this from the ground up. First, we'll tackle the absolute foundation, corporate residency. Then, we'll define a very special type of company called a CCPC. From there, we'll dive into the incredible tax advantages it offers, look at how those benefits extend to shareholders, and finally, we'll wrap up with the essential compliance rules you need to be aware of.
Okay, let's jump right in. The absolute starting point for every conversation about Canadian corporate tax is determining residency. This isn't just a trivial detail, it's a pivotal concept. Why? Because it defines the entire scope of a corporation's tax obligations to Canada.
So what does this actually mean in practice? Well, it creates two very different paths. If your corporation is considered a resident of Canada, then you're on the hook for Canadian tax on your income from everywhere in the world. But if you're a non-resident, Canada only taxes the income you generate from your business and investments inside Canada. Getting this distinction right from the get-go is absolutely crucial.
So, how is this residency status actually determined? Well, it's not based on just one thing. The tax authorities use a combination of three key tests. The first one is the most straightforward. If you incorporate your company in Canada, it's generally considered a Canadian resident. But that's not the end of the story, which brings us to the much more subjective common law test.
Now this is where we get to the real substance of the matter. The common law test is all about finding the place of effective management. It asks a simple question: where are the big, strategic decisions actually being made? Forget where the company is registered for a second. If your key directors are meeting in a boardroom in Toronto, making those high-level, guiding decisions, then Canada Revenue Agency could very well deem your company a Canadian resident, even if it was technically incorporated elsewhere.
Okay, so once we figured out residency, we can drill down to a very special classification, the Canadian Controlled Private Corporation, or what we all call a CCPC. And I want to be clear, this isn't just some technical label. It is the key that unlocks some of the most significant tax advantages available in the entire Canadian system.
So to earn that CCPC status, a corporation has to check three boxes. 1, it has to be a private corporation. 2, it has to be a resident of Canada, which we just covered. And 3, this is the big one, it cannot be controlled, either directly or indirectly, by non-residents or by public companies. And that word control is what it all hinges on. In the tax world, that almost always means holding more than 50% of the voting shares.
Let's make this real with an example. So a Canadian resident owns exactly half the shares, and a non-resident owns the other half. You might think that's a problem, but it's not. The key is that the non-resident shareholder does not have control. They don't have more than 50%. So in this scenario, the corporation absolutely maintains its valuable CCPC status.
Now, here's where it gets a little more nuanced, and you can see how important it is to look at the full picture. Tax authorities don't just stop at the first layer of ownership. They look all the way up the chain to find who has ultimate control. So here, Corporation A is owned by another Canadian company, which seems fine. But that parent company is 51% owned by non-residents. That control flows down, and as a result, Corporation A loses its CCPC status.
All right, now for the part everyone wants to know about, the payoff. Why do we care so much about this CCPC designation? Because it has a direct, measurable, and very significant impact on a business's bottom line, specifically when it comes to the money it earns from its active, day-to-day operations.
This is the magic number to remember: $500,000. A qualifying CCPC gets a massively preferential tax rate on its first $500,000 of what's called active business income. And I have to stress that part. This benefit is specifically for the earnings that come from your core business, making widgets, providing services, not from passive activities like collecting rent or investment income.
Let's actually look at the math, because this table tells the whole story. As you can see, both types of corporations start with the same 38% gross tax rate, but the game changer is that fourth line, the small business deduction, or SBD. It's a whopping 19% reduction that's only available to the CCPC. And that one line item is what drops the net federal tax rate from a standard 15% all the way down to just 9%.
And when you see it visually like this, the difference is just so stark. That 6 percentage point advantage at the federal level translates into a tax saving of up to $30,000 a year. That's real money that can be reinvested directly back into the business for hiring, for expansion, for innovation.
But, and this is a really important but, there's a flip side. The entire system is purposefully designed to encourage active business, not to create a tax shelter for passive investments inside a corporation. As this quote points out, if you hold investments that generate things like capital gains or rental income inside a CCPC, that income can be taxed at a very, very high rate, which can completely wipe out the benefits we've just been talking about.
So the company itself saves a bundle on taxes. That's great. But the good news doesn't stop there. The benefits of being a CCPC actually extend directly to the people who own, run, and invest in the business. We're talking about shareholders, key employees, and other investors.
This right here is perhaps one of the single most powerful wealth creation tools available to entrepreneurs in Canada. It's called the Lifetime Capital Gains Exemption. What it means is that when an owner sells the shares of their qualifying small business corporation, they can shelter over $1 million of the capital gain from any tax whatsoever. It's an incredible incentive. Now, there are conditions, of course, like you need to have held the shares for at least 2 years.
CCPC status also provides a major leg up when it comes to attracting and retaining talent with stock options. Let's think about this from the employee's perspective. For a regular company, you get a tax bill in the year you exercise your options, even if you haven't sold the shares and don't have the cash. But for a CCPC employee, the tax is deferred until they actually sell the shares. It's a massive cash flow advantage. You only pay tax when you have the money from the sale in your bank account.
And for companies that are pushing the boundaries of innovation, the advantage gets even bigger. The government's SR&ED program, that's Scientific Research and Experimental Development, offers enhanced tax credits to CCPCs. They can get a refundable credit of 35% on their R&D spending. That's more than double the 15% rate for other companies. It's a huge signal from the government to invest in R&D here in Canada.
Okay, so we've seen all these amazing benefits, but to get them, and more importantly, to keep them, you have to play by the rules. So let's wrap up by touching on some of the essential administrative points, the compliance basics that you just need to know. Here's a small but very valuable cash flow advantage for CCPCs. While all corporations get 6 months after their fiscal year end to file their tax return, a CCPC gets an extra month to actually pay the tax they owe. They have 3 months after year end compared to just 2 months for a non-CCPC. And in business, as we all know, cash flow is king. Now, this is a unique and really important rule that provides a kind of safety net for people investing in Canadian small businesses. If your investment in a CCPC goes south and you have a loss, it's classified as an allowable business investment loss, or an A-bill. Think of it as a kind of super loss. Unlike a regular capital loss, which can only offset capital gains, an A-bill is far more flexible. You can use it to reduce your taxes on your salary, your business income, pretty much any source. Finally, understanding these carryover timelines is crucial for long-term tax planning. A loss you incur this year doesn't just disappear. Each type of loss has different rules for how far back you can apply it to get a refund on past taxes, or how far forward you can carry it to reduce future tax bills. Knowing that an A-bill can be carried forward for a decade, for example, allows for some very strategic planning. So, as we wrap all this up, we've seen pretty clearly that the distinction between just any old corporation and a Canadian-controlled private corporation is not just an academic exercise. It has profound, real-world financial consequences for the business itself, for its owners, and for its employees. This really drives home the point that understanding your corporate structure isn't just about legal compliance. It's a fundamental key to maximizing your entrepreneurial and investment success here in Canada.